Hi, good morning, everyone. Thank you for joining us today in our Phillip Securities Research Weekly Morning Call. Today, we have a few stock counter updates, including the initiation on Tesla and quite a few Phillip on the ground. Then we will be followed by the technical analysis as well as the sector outlook, which includes the update on the semiconductor industry and the usual Singapore Weekly. So without further ado, I'll start off with the semiconductor update. So we have also published our reports on this as well. What we have done here basically is we've compiled all the year-on-year revenue and PATMI performance for the major semiconductor companies during the quarter, as well as the guidance for the third quarter as well. So we have segmented the market into four segments, which are processor, memory, equipment makers, as well as foundry. So as a summary, you can see from the table, the only ones with the strong results are Nvidia as well as ASML, and this is because both of them are the major, if not the only player in their respective markets. So yeah, I'll start off with the processor market. So here we have your CPU and GPU makers, which are your Intel, AMD, and Nvidia. So for Nvidia, I will run through the results later, following this slide, so bear with me on that. But for Intel and AMD, both of them reported a sales decline during the quarter, mainly because they continue to see customers having elevated inventory. However, interestingly, both companies are expecting their consumer CPU business to ship closer to consumption in the second half of this year, whereas they're expecting their server business to continue to see elevated inventory. And this is because the cloud service providers are focusing more of the investments towards AI-related businesses. So, which means that they continue to buy more GPUs, mainly from Nvidia, basically, instead of buying the CPUs from both Intel and AMD. However, I think the similarity ends there because Intel has guided for a continued revenue decline for the third quarter, whereas AMD has guided for a slight growth for the third quarter in terms of sales because they're expecting a slight growth for their consumer CPU business. So that's for processors. Now moving on to memory. So we have the three big players here, which are your Micron, Samsung, and SK Hynix. So memory is the main lagging segment for the semiconductor industry. So all three companies have recorded a 50% year-on-year revenue drop. And this is again mainly because of still high level of inventory in their customers, as well as the declining prices as well. However, all three companies have said that channel inventory levels have improved during the second quarter, and they are expecting this trend to continue towards the second half of this year as well. And thus, it will slow the price decline of the memory too. And then all three companies says that they are expecting the supply-demand balance to improve further in the second half. And this is mainly because the effects of the production cuts materialize gradually. And then there's also the benefit from the strong seasonality because of new customer product launches there. So although the overall market is bad, the bright side on the memory market is the strong demand for high bandwidth memory as well as DDR5. So what these are is basically the high-end RAM that is used in AI servers. So because cloud companies are investing more heavily on AI-related businesses and AI-related deployments, they will require this more high-end RAM. So yeah, all three companies are seeing strength in that area, but however, the strong demand for these high-end chips is still insufficient to offset the decline, mainly because DDR5 and high bandwidth memory still accounts for only a small portion of the overall memory market. So moving on to the equipment makers. So here we have your ASML, Applied Materials, and Lam Research. So equipment makers too are seeing the effect of the industry down cycle and they have all cited the particular weakness from their memory customers. And this is because since memory is the main laggers in the industry, a lot of the memory makers are cutting back on their spending for the year, which we can see, they have said that memory spending is at its lowest level in more than a decade. So out of the three companies, ASML was the strongest one, as they report a strong 30% year-on-year revenue growth, mainly because they are still the main supplier of lithography equipment and they have a very large order backlog. And then out of the three, Lam was the only one that reported sales decline during the quarter, mainly because it has a high exposure to the memory market. Then all three companies are seeing the foundry customers pushing out their orders for equipments that are used to make advanced chips. And but they have also said that this is somewhat compensated by the strong demand by domestic Chinese customers who are investing in equipments that are used to make less advanced and mature chips technologies. However, despite this headwind, ASML is still going to be strong throughout the year, and they are still guiding for a 30% year-over-year revenue increase for FY23, as their order book remains very robust, and the demand is still surpassing the supply, the ability to supply. Whereas both Applied Materials and Lam Research have already guided for negative growth for Q3 and likely for the Q4 as well. But yeah, so that's for the equipment makers. Then lastly, for the foundry, we have TSMC here, as since they are the biggest there. So for TSMC, they have reported a revenue decline for Q2, and frankly, their outlook is not very good because they are expecting sales to be down in Q3 as well, and actually mainly for the second half of the year too. And this is mainly attributed to the fact that the macro environment and China recovery is not as solid as what they have expected initially. So apart from AI-related businesses, which are the bright spot for TSMC, they said that all the other applications for their chips, for their products, are going to be weak in the second half of this year, which is why they have guided for FY23 revenue to be down by 10% year on year. So yeah, since AI-related demand is strong, but it is still it is still insufficient to offset the weakness from the overall decline in the other end markets, mainly because AI-related demand is still only about 6% of TSMC's total revenue. But the company did say that this is going to grow by 50% CAGR in the next 5 years and will be the largest growth contributor for the company. So just to clarify, the AI-related demand for TSMC is your CPU, GPUs, as well as other AI accelerators used for training and inferencing in AI models. So yeah, that's the update on the semiconductor results. I'll now go towards the earnings report on Nvidia. So we have published our reports on Nvidia second quarter earnings. So these are some of the highlights. Overall, the second quarter results has exceeded our expectations. So we'll just jump straight into the positive. Firstly, the data center business is driving a very strong revenue beat. So overall revenue doubled year on year, mainly because it was above the company guidance of $11 billion. And this can be mainly attributed to the data center segment nearly tripling year on year in terms of sales, and it makes up about 3/4 of the company's total revenue. So the strong results is because customers continue to focus their investment on AI-related deployment, which is why there's an increasing demand for their HGX server platform. And then because data center business is of high margins, the gross margin also expanded by 550 basis points quarter on quarter, as well as 26.6 percentage points year on year. Then the second positive is that they have also issued an even stronger guidance for the third quarter. So for the third quarter, Nvidia has said that they are expecting the overall revenue to nearly triple year on year. And again, the growth will be mainly driven by the data center segment also. Because of the such strong demand, the company said that it has a demand visibility that extends into next year. And the company says that it is now actively working with its suppliers to be able to expand the capacity so that they are able to fulfill all the customers' demand. So, and then for the third positive is that their gaming segment has returned to positive growth after the decline since the second quarter of last year. So it has been fourth straight quarter of revenue year-on-year decline. So the gaming segment was up by 22% year-on-year, mainly because of the increasing adoption of its GeForce RTX 40 series GPUs. And partly of this is because of the back to school season, whereby students are buying laptops or new PCs that enables them to use for their study needs. And then Nvidia says that it believes the global end demand has returned to growth following the slowdown since the second half of last year. So those are the positives. Now moving on to the negative. Although this is not really impactful because these two segments only makes up a very small portion of the total revenue, but we think it's quite important to highlight as well. So professional visualization was down by 24% year on year, but this is a very good improvement from the 53% decline in the first quarter. Automotive was up 50% year on year, but apparently it declined by 15% quarter on quarter. And the quarter on quarter decline was mainly because of the lower demand from the Chinese and NEV makers. So yeah, moving on to the outlook. As I mentioned just now, the company is expecting the third quarter revenue to be 16 billion or nearly tripling year over year. And and this is mainly driven by the data center growth. So during the call, Nvidia says that there's $1 trillion worth of data center infrastructure worldwide that is shifting to accelerated computing as well as generative AI, which are the target markets for Nvidia now. Which is so because of this, Nvidia believes that this transition is going to be long term, and thus it allows the companies to grow. This allows for a sustained growth in demand for the next subsequent years. And then lastly, Nvidia is also ramping its server CPUs, which is named as Grace. So in fact, one of the super chips, which is one of their products of combining the CPUs and GPUs onto a single chip, is already in mass production and will be available starting this quarter. So we believe that the Nvidia's entry into the CPU market is going to threaten the market share of the other two leading CPU makers, which are your Intel and AMD, mainly because being a product made in-house, we think that there's a high chance that it's going to be working more seamlessly when you use it with the Nvidia GPUs compared if you're using it with the Intel and AMD CPUs. So yeah, for our valuation, we upgrade to a buy rating from Accumulate with a risk DCF target price of $645. We have increased our revenue and PATMI assumption by 35 and 69% to account for the stronger than expected data center growth. And our valuation was using a weighted average cost of capital assumption of 6.8% and terminal growth rate of 4.5%. So yeah, that's all for me. I hand over the time to Jonathan to run through the initiation on Tesla. Thank you.
Thanks, Max. And good morning, everyone. So we recently issued our initiation report on Tesla, I believe last Friday, with the title Driving an Electric Future. Slide, please. Okay, just a brief background. The market cap of Tesla is around $700+ billion US. It's currently the leader in the EV industry outside of China. Obviously, if you take into account China, BYD essentially is the main, I guess, the leading EV player, but it's a little bit difficult to quantify because they also incorporate a lot of your, not just your battery electric vehicles, but also a lot of your plug-in hybrids. So it's not really a pure play EV company, but it's also very difficult to distinguish. So we kind of just lump it together. In terms of how many factories Tesla has, they've got about 5 gigafactories across the world. They're planning to build another one in Mexico to produce some of their newer model products. In terms of their energy storage, like a picture over here on the bottom left, that's actually one of their mega packs, or essentially what your mega pack would look like, which is an energy storage facility. This is more on your commercial or industrial size, whereas power walls are for residential use. And then for services, the main service that they provide, they have end-to-end servicing of your vehicles, maintenance. They also have supercharging, which is the picture on the bottom right, and they also do their own vehicle insurance. Next slide, please. In terms of revenue, 88% of total revenue comes from the sales of their EVs. So it's the majority of their revenue right now, while services and energy make up a relatively smaller portion. About half their revenue comes from the US, with about a quarter coming from China and the rest of it coming from other parts of the world, predominantly in Europe, but it has been expanding outside of Europe as well. In terms of production and delivery capacity, Capacity over the production over the last 12 months is about 1.7 million vehicles. So that's like a 56% year-on-year growth rate. While deliveries are slightly less because there's a bit of a lag while vehicles are in transition. Total capacity right now is more than 2 million installed vehicle capacity across its factories. Um, but that so it kind of tells us that production right now is almost is very close to maximum installed capacity. So it'll be a little bit more difficult to ramp up production, given these are the main constraints there. Next slide, please. In terms of the investment highlights, first investment highlight that we have is Tesla has superior products with very robust demand. They've over most of their calls, they've always mentioned that there's no issue with demand, and this is quite evident with the long delivery wait times of about 6 to 9 months from the time a customer purchases to the time it actually gets delivered. At the same time, they have a very fast-growing energy storage business, like I mentioned earlier, which is its Megapack and Powerwall. And this is a little bit more apparent in rural parts of the US, where electricity may be unstable due to seasonality. And so by providing these kind of solutions where the downtime is almost non-existent, where it's 99% uptime, the company is able to provide better energy flow to support the grid whenever the grid goes down. We do expect revenue to taper down a little bit over the next couple of years. One of the main reasons is because the company is fairly limited by supply, so it can only really produce a maximum of 2 million cars a year, which essentially next year will be a very significant deceleration in growth. At the same time, there is also quite a lot of pricing pressures in the EV industry, especially from Chinese automakers. They're really cutting prices, and it is a very competitive landscape. So we do expect some of these to contribute to some sort of decline in revenue, I guess a deceleration in revenue growth, but we do expect some sort of acceleration past 2024, especially after Giga Mexico is completed and production starts to ramp up a little bit again. The second investment highlight is that Tesla currently has industry-leading margins. So gross margins are around 20%, about 2 times the industry average. And there are several reasons for this. Firstly, they have a very vertically integrated supply chain. So they control a lot of their supply chain and do a lot of their things in-house. Judging from I guess they don't source their own raw materials, but they are starting to refine, or they're building a facility to actually refine lithium. Because there is a shortage right now of lithium refineries, so there's also a slight bottleneck as to how fast Tesla can ramp up. At the same time, they're also simplifying the design of their EV so that they're making it so that there are less parts to assemble, making the electrical wiring a lot simpler so that it's easier to assemble and also easier to maintain and service. Thirdly, they're also improving assembly lines so they can fit in more parts being assembled at the same time compared to traditional OEMs, which speeds up your production, obviously. And lastly, they've been able to reduce their battery dollar per kilowatt hour cost, which is very significant because battery costs takes up about 25 to 30% of the overall EV cost. So if you can bring that down, it significantly reduces the cost to produce your one EV. So the chart on the bottom right kind of shows, how Tesla has been able to reduce its average cost per EV. So from about 75,000 in 2018 to right now it's about 40 plus thousand. So it's quite a significant reduction, about 40% reduction in cost per EV. And their main goal is actually to continue reducing it so that they're able to produce a $25,000 EV, because that's essentially where you open up yourself to a wider market, because that's really the mass market pricing where you can compete with other traditional popular vehicles like your Toyota, Camry, and so on. So right now, because prices are a little bit elevated, so it's still considered a little bit more on the I guess mass affluent or premium pricing. Your total addressable market, or your addressable market right now is relatively small compared to if you bring prices down. And so Tesla so far has been able to maintain their margins while also reducing the prices of their vehicles, which we think is a very important point. Next slide, please. Moving into the last investment highlight, which has to do with regulatory tailwinds. Right now there's a lot of zero emission tailwinds. More and more governments are imposing policies and regulations to promote zero emissions. Interesting stat is that 90% of EVs sold last year was actually covered by some sort of government incentive. And we think that this obviously contributes to in improving the affordability of EVs and also pushing more consumers to transition away from ICE vehicles into electric vehicles. What we think will happen is that this is going to continue, especially as more and more countries come on board. A lot of countries have 2035 mandates for zero emissions, and some have even basically banned ICE vehicles by 2035 or 2040. And so this should provide significant tailwinds for not just Tesla, but the overall EV industry as a whole. We do expect about 40% of all new vehicle sales to be EVs by 2026. Up from right now is somewhere around 25-30%. So, about 10-15% increase. Next slide, please. Moving into some of the risks that we see. Number one would be competition and pricing pressures. Like I mentioned earlier, there's a lot of competition from newer EV players from China that are trying to expand outwards. And this basically, contributes to higher pricing pressures because everybody is trying to get more and more market share. Even if it costs them money to sell a vehicle, or costs them to lose money to sell a vehicle, they're still right now doing it because a lot of these companies are in their growth stages. Secondly, in relation to Tesla's energy storage business, if there's a decrease in electricity prices from utility companies, it could make their energy storage business a little bit less attractive and decrease the volume of energy output, or rather, energy storage output that they are actually currently providing to consumers. The second risk will be policy risk. Like I mentioned earlier, a lot of the governments are giving incentives. Just for example, in the US, the US government is giving about 7,500 tax credits to offset an EV purchase. So that makes up about 15 to 20% of EV. So it's a significant discount. And if there are any negative changes or reversals in any policies, it could significantly impair customers' ability to purchase Tesla's products because they are a little bit more on the premium side right now. The last risk that we see is that there are still very significant regulatory hurdles for its full self-driving software. And this is quite important because FSD, we think, is going to be the main margin driver, or the main margin expansion driver moving forward, because it is like a software, so you have software margins of 70-80% gross margins. So the hurdle right now is that regulators aren't really 100% on board, and they haven't given any regulatory approval, especially in Europe, for Tesla to use this kind of software as a fully autonomous driving vehicle. And so we think that because of this, the uptake will still be a little bit sluggish. And so contribution from FSD will not be so meaningful until at least regulators start to approve FSD to be used as a fully autonomous driving software. Moving to the next slide. So just a basic calculation on the rule of 40. Right now for Tesla, it's currently at 75%, so it's your 54% 3-year average revenue growth plus 21% EBITDA margins. So that's definitely above our 40% threshold. In terms of valuation, we initiate coverage with an accumulate rating and a target price of $265 US. With a weighted average cost of capital on 9% and a growth rate of 5%. We think that Tesla is well positioned to capture a lot of the EV market, especially as the EV market continues expanding, for the future. So that's all for Tesla. I'll move on to my next counter, which is TDCX. So TDCX also announced their second quarter results last week. Just for some background, TDCX is an outsourced customer experience company where most of their business comes from its call centers, while they also do some sort of sales and digital marketing consultation and services for their customers. But most of the revenue comes from their omnichannel CX. Results were roughly in line with our expectations, with earnings helped by a 6 times year-on-year increase in interest income. Because they're sitting on quite a lot of cash right now, about 300 million from their IPO. They haven't really spent any of it. So what they did was essentially just put it in a lot of your interest-bearing instruments like your fixed T and money market funds and so on, just to generate some sort of income from there. What continued to do well was they continued to diversify their revenue. And this was quite an issue in the past because most of their revenue actually came from their top five clients. And so what they've been able to do is obviously acquire new clients and diversify some of their revenue away from their concentrated top 5 clients. So it's a little bit less reliant on those clients. At the same time, their expansion in Brazil is actually doing pretty well. And Brazil is actually a very strategic expansion because prior to Brazil, they also are in Colombia. And so with Brazil, they're able to capture 2 of the largest languages in South America, which is Portuguese and Spanish. And so with these kind of language capabilities, it's a little bit easier to cross-sell and expand your client base there because you essentially have the capabilities to service the whole continent. In terms of what didn't do so well, which essentially led to a lot of the poor outlook, was that TDCX saw one of their key digital advertising clients cut seat volumes, moving into the second half of 2023. Even though they did say that they were probably going to keep it quite steady, they kind of did a little bit of a U-turn. Their key digital advertising client essentially is Meta, which is a little bit surprising because they issued a very strong set of results. Second negative was the travel and hospitality vertical was quite disappointing because the company was actually banking on a lot of your China outbound travel that really hasn't materialized yet. And because travel and hospitality is one of their largest verticals, there was some disappointment in terms of revenue growth. They expected a little bit more revenue growth from this sector that just didn't happen. The last negative was the company reduced their 2023 overall revenue and margin guidance. So they actually reduced their revenue guidance from 3 to 8% to 2 to 4% in constant currency. So if you think about it from FX, if there's like a 5-6% FX headwind, essentially that means at best case you have no growth year on year. Worst case, you're down about 3 or 4% year on year. And so we had to adjust our 2023 estimates accordingly. Which brings me to my valuation. We actually cut our revenue and PATMI by 6% and 11% because of the weak outlook for the second half of this year. We did bring down our DCF target price from $12.10 to $10.40, but we still maintain a buy because we think that long term, TDCX is still well positioned to maintain to capture a lot of the outsourcing CX market, especially in emerging markets like Southeast Asia and Latin America. And a big reason for this is because TDCX actually specializes in a lot more complex services. So it's not just your simple, I guess, when clients call in, they don't really do the "can you help me reset my password" kind of queries. They do more complex queries like rebookings and stuff like that that takes a little bit more skill from its employees. And so because they're a little bit geared towards these more complex services, and the needs of a lot of their clients are actually evolving into more complex solutions. So there's a demand there for a lot of these outsourcing CX companies like TDCX. So that's all for TDCX. I'm moving on to my next counter, which is Grab. They also announced their second quarter results. And we did a Phillip on the ground because we actually don't cover Grab right now, but we just attended a call last week. So just to reiterate, it's not rated, and the last close price for Grab was $3.70. Main thing for Grab is revenue grew very well, 77% year on year, because and this was across the board across its 3 main business segments. Although revenue growth did decrease sequentially from the first quarter, but it's kind of expected because revenue growth in the first quarter was about 130%. So a little bit not really that sustainable, but very in line with a high growth company. But the key thing was that Grab was able to reduce their net loss by 74%. So they only lost about $148 million in the quarter. And the main ways they did this was to reduce a lot of their incentives, as well as they cut headcount, and they were able to reduce their corporate costs by about 10%. Because they cut about 1,000 employees in the second quarter of this year. The key questions on the call were about their Transcap acquisition, because I think many people are confused as to why a platform company would purchase a traditional taxi company. And one of the explanations for this was, firstly, they had a supply issue for its drivers, and this was actually bumping up a lot of the prices for a lot of the Grab rides, especially in Singapore, leading to Grab rides being, I guess, less affordable to consumers. And so what they wanted to try and do was to improve supply, and this, obviously, by acquiring a taxi company, you naturally improve, because you increase the number of drivers you have. At the same time, it also is able to reduce their cost to serve, because with a taxi license, you're able to purchase COEs at a lower cost compared to if you didn't have it. And this essentially helped them to reduce, or will help them to reduce their overall cost to serve moving forward. Moving into their other segment, which is their financial services, something very interesting is that 43% of the revenue from financial services was actually from their lending business. So they are moving a little bit away from your transactions on GrabPay, and kind of figuring out that your microfinancing, your lending division, it's a little bit, I guess, it's a little bit easier to generate more revenue from that. But at the same time, it also increases a lot of the risk, because lending is a much higher risk business than just taking a commission of your transactions. In terms of GXX, which is their digital bank, they increased the max deposit from 5,000 Singapore dollars to 75,000 Singapore dollars. But at the same time, they also reduced their interest rates to slow the inflow of deposits coming in, because they mentioned that there was such high demand for its deposits, and they didn't really want that much deposits as of this time, because more deposits, they're going to pay out more in terms of interest to its consumers. They also did mention that Digibank should break even in 2026, which is kind of far away. But the good thing for their outlook is that on an adjusted EBITDA break-even point, they brought it forward from the fourth quarter of this year to the third quarter of this year. Adjusted EBITDA essentially is taking out your depreciation, interest. The adjustment is mainly for your share-based compensation and some one-offs like restructuring costs, etc. And so the key for Grab is that their profitability is improving a little bit ahead of schedule, and a lot of analysts do expect Grab to be profitable sometime next year, at least on a EBITDA level. On a net profit level, I think probably end of next year, maybe somewhere in the early 2025. So that's all for Grab. Grab's Phillip on the ground. I'll hand it over to Peggy for RH Petrogas. Oh, sorry, to Meow Meow for China Aviation. Thank you.
Thank you, John. So we conducted Phillip on the ground for China Aviation Oil. Next slide, please. So we don't cover the stock. It's not rated. It's the largest purchaser of jet fuel in Asia Pacific region and supplies of jet fuel to civil aviation industry of PRC. Its business involves jet fuel supply and trading of other products, and investment in oil-related asset. So they released their first half 2023 result. Gross profit declined 51% year-on-year due to fewer trading and margin optimizing opportunities. And share of associates profit declined 15% year-on-year, as SPIA, which is their subsidiary, their stronger refueling volume were offset by the 1.7 million inventory impairment due to the declining of oil price. And jet fuel supply volume of 3.8 million, which declined 9% year-on-year, as recovery of outbound flights from China was still very low. However, their core net profit, which is 20 million, was flattish year-on-year, mainly due to the increase in other income. There was a 10 million interest income. Yeah, as for the outlook, The management stayed positive in the second half to 3 as the oil production in China was resumed in June, and the profit margin remains good as the regional price difference is opening up gradually since July and will be reflected in the second half result. Last but not least, international flight now is back to 55% of the pre-COVID level. And the management also expect the flight capacity to be further restored as China just finished the biggest political meeting in July. And they has mentioned during the meeting, there will be more stimulative policies, particularly the US and UK flight. And also, we don't see any more delays faced by the Chinese citizen in renewing their passport and also obtaining visas. But also, the management guided that it will be less likely to see international flights capacity to be back to pre-COVID level this year, FY23. Yeah, that's all for China Aviation Oil. I'll hand over to Peggy. Thank you.
Thank you, Miao Miao. Okay, Philip on the ground for RH Petrogas. We met with the company. Okay, after the first half results, basically two key takeaways from the meeting. First thing is the profit decline and revenue also fall. If you look at the chart on the left hand side, the bottom chart, even though they raise output, when the crude price, realized crude price was down to $76, the revenue just go down in line. Okay. They managed to increase some output production to 5,000 barrels of oil per day. That's also means they put in a new rig to do the work, and now the rig day rates have stay very high because there's very little investment in new rigs. So that has pumped up their operating costs. So production costs, unit production cost has gone up to nearly $40 US dollar per barrel. If you look at the chart on the right, bottom chart on the right, so the spread between the selling price and the cost have narrowed. The management says that they will manage to bring down the full year's unit cost to about $38 per barrel and maybe $35 per barrel for FY24. But still, this is still higher than the last 2 years. So there's something to watch, especially if the oil price see some downward pressure. You look at the data on the chart for FY20, when the spread between the selling price and the cost narrowed, they incurred a loss in FY20, not just because of the narrowing spread, but also for those costs that they incurred, which they capitalized as exploration costs, will then have to be written off or written down to reflect the lower oil price. So their profit is really very geared to crude prices. The second takeaway is that there's some opportunities for RH Petrogas come 2025. They are planning to drill 3 exploration well and 1 development well in 2023. One of the exploration well is a gas well that they will start drilling in September. In 2 to 3 months' time, they will be able to tell whether they can find gas or meaningful amount of gas under that well. If successful, then they have already signed an MOU with the to supply the gas to the Indonesia Green Nickel Technology. Short is Ignite Eco Park. This is the nation nickel processing project for Indonesia, and it's going to be a big supplying to the EV industry that will be based out of Indonesia. So if they are successful, they will begin to supply about 80 million barrels a day of gas, barrels of oil equivalent but of gas from first quarter 25. But of course, all these numbers are really big numbers, estimates, and geologists, as you know, are pure optimists. So as analysts, we will need to see by December to see whether they really find anything under that well. Okay, so they have net cash of $64 million, which they will need to cover capex spend for this year and next year. So they're likely not going to pay any dividend again. Okay, that's all for RH Petrogas. I'll move on to the next one. Yanlord Land. Okay, we also met with them. There was a conference call. So sorry for being so messy here. There's quite a bit of data dumping here, but I was trying to highlight how to distinguish them from the other property developers in China. As we hear most recently we had Country Gardens announced a profit warning, issue a profit warning, and Evergrande just released the results this morning. We saw the 80% decline in the share price this morning in Hong Kong. Okay, back to Yanlord Land. They most of their land bank in China, 3% in Singapore. Out of the profit of top line, about 75% is generated from property development. So that's a very big part of their very significant for them. Then through UE Limited, which they had a GO in 2019, they also had some engineering business in UK and Australia. Okay, the the good thing about Yanlord is that out of the land bank of 9.1 million square meters, 75% are in Tier 1 and Tier 2 cities, 3% in Singapore. So these Tier 1 and Tier 2s are relatively healthier compared to the other parts of China in terms of property market, especially in the recent steep downturn. Tier 1 and Tier 2 cities stand a better chance of being able to weather the storm. Okay. In the first half of 2023, we saw Yanlord had new starts, that means new construction of 389,000 square meters. That's only 4.3% of existing land bank. So that's not big. And most of these are in Suzhou, Nantong, and Zhuhai. So the risk there is pretty contained. Management said that they will continue to remain cautious on land acquisition. They're still focusing on Tier 1 and Tier 2 city and the Greater Bay Area. Also, in the first half of this year, they acquired 287,000 square meters of land. That's 3.2% of existing in Tier 2 cities, and the average cost of about 10,766. So if we project a construction cost about 6,000 to 8,000 RMB per square meters, and looking at their average selling price of about 20 over 1,000, that looks like there's still a small margin to be made, though it's getting thinner. Okay. The land cost as a percentage of their contracted sales this year, same period, is about 0.3 times. Highlighted this number because we think this indicates two things. One is whether in the future growth for the company, because this land will be converted into development and for sale. That's the goes. Second thing is land acquisition in China. You cannot take a bank loan for land acquisition. So in the past, what the other property developers do is they sell a property, they collect all the money upfront, and then they use the money to invest in a new land bank, the next property land purchase. So this was how it's more like a Ponzi scheme. But this has no longer be allowed. They have adopted an escrow model, like something like Singapore. So therefore, this land acquisition show us the confidence of the management in being able to manage their cash flow. So for Yanlord, the first half 2023, they generated free cash flow of about 3.9 billion RMB, which we think is a very healthy sign. Yeah. But the only concern, not concern, but the only point to note is that all the total land bank completed for sale accounts for about 20% of total in terms of value as well as in terms of square meter. So this number could this completed for sale could face the risk of a decline in price, in selling price if the take up becomes slower, because as it takes longer to sell, then your interest costs begin to build up and your cost will rise. Okay. So on the debt side, they had about about 43% of their debt are short term. But out of this short term debt of 17.8 billion, 77% are project related. So the only senior notes due is in February 2024. This $400 million senior note, they had already bought back and canceled some, so they left with 376 million for this senior note at 6.8%. So management is geared, focusing on just repaying these senior notes. So again, dividend might not happen this year again. Okay. One thing I realized from studying the Chinese property developers is the gearing figure does not tell much of a story. Like for instance, for them, gearing 0.47 times is Country Gardens is also about this level, but because of the way the revenue model, the gearing not so reflective of the health of the financial health of the company. Okay, what is the spillover effect from Country Gardens? What we think is that it will shrink the addressable market. Buyers will hold back because they are worried, especially for developments where the developers does not sound to be in good health. Okay, then they also worsen the financial institution stance towards the private developers. They might prefer the SOEs instead. And suppliers and project partners will also be alarmed. So we think refinancing would be more challenging, and property sales in the lower tier cities may further deteriorate. So therefore, there are risks for Yanlord we see, but compared to the other property players, their bigger exposure to tier 1, tier 2 cities could help them tide through this period. So what can help and what we think we hope to see is that if the lower interest rates, which is happening already, the LPR is lower. That will help to reduce the mortgage refinancing, mortgage rates, and so that will the buyers who already own the property can seek mortgage refinancing at lower rates, and that will then reduce the supply in the secondary market for these properties. So it is some pressure for the property developers. The second thing is we hope to see more is the relaxation of restrictions of mortgage and home purchase in the tier 1 and tier 2 city. Typically, tier 1 and tier 2 city face the most restrictions. So lifting these restrictions looks like the lower hanging fruit for the authorities. And typically also because of these restrictions, it has really led to stronger demand into the lower tier cities, and then especially the towns with very low GDP, very low population, that the past demand in those cities were really pure speculative plays. So being in tier 1 and tier 2 would benefit, we think, from a more greater relaxation of the restrictions. Yanlord is trading at about price to book. This is last Friday's price, but I think that today it jumped already. The price to book 0.19 times. Country Gardens, not very far from Country Gardens of 0.15 times. Lowest level Yanlord traded was 60.5 cents in November 2008, and Yanlord hasn't raised any money from the equity market since. So I go on to the next slide to show you some of the comparison. So Yanlord is far smaller than Country Gardens. It is pre-sales and etc. is only Country Gardens is about 5 to 6 times larger than them, right? But if you look at the average selling price, Country Gardens has, because they have 98% of the exposure in tier 3 and lower tier cities. So the average selling price is about 7,800, RMB per square meter. Yanlord is about 26,000 in the first 7 months of this year. 26,000 RMB per square meter. So that is a this number could face pressure, downward pressure, but relatively probably much stronger than those who are in the lower tier cities. Yeah, that's all for Yanlord. I move on to the next one. Next, thanks. Okay, LMS Compliance, we hosted them at a webinar. Just a brief run through of the business. It provides lab testing, assessment, certification. So it's a pure service provider. So the very strong, very big margin, 92% gross margin. Even net margin is also very sizable. EBITDA 43%. And also because they don't need a very big balance sheet, so ROE and ROIC are very, very high. Right. So how to group scale the business is really for them to add more labs, to add headcount, and also if the trade volume in Malaysia pick up, because they operate mainly only in Malaysia. Currently they have 3 labs in Malaysia. They're going to add one more, looking to add one more in Sarawak. And they also have a sales office in Kota Baru. What drives the business demand for the business is really when companies need to import or export items out of the country, they will need to meet the import and export requirements of the other country. So therefore they will need certification by them to verify that their quality is there, the product is safe, and so on. So they cater to a wide range of products in food, feed, medical, drugs, equipment, masks, even, yeah, anything along, even mineral oils, and the testing on the amount of gold you find in a sample. Yeah. So it's really the business of this company is really pegged to the trades, import and export on volume in Malaysia, we believe. But still it's a very, very small business. The profits like less than 1 million or 1 million Sing dollar a year. So it takes a long time to scale. Yeah, thanks. That's all for LMS Compliance. Next, GHY. Yeah, that's my last video on the ground. Okay, this company produces movie, dramas, concerts, all the entertainment that you can think of in terms of physical, in physical, and as well as the virtual version. Okay, you might be wondering why I put up a column FY20 in this table here. No, I didn't make a mistake. This is why I put it up here is because the management says at the core that they expect to FY24 to return the profit to return back to pre-pandemic level. Okay, in FY19 they make 12 million net profit. FY20 38 million. But during the conversation, the CFO talked a lot about FY20 and how they can return back to FY20 numbers. Okay. So this company, firstly, is about 7% owned by Jay Chou's mom, indirectly. She also owned another Hong Kong listed company that's just listed. It's called Star Plus Legend Holdings. Okay, so we asked them, is there any overlap, or would one day Star Plus replace your take over your business? As you say, no, there's no overlap. For GHY, the market for Jay Chou's concerts are in Singapore, Malaysia, Australia, Japan, Thailand. Then they don't go in the China cities. They only go in via investments. That means they don't do the production. They don't organize the events. They just an investor in those. So So that's how they split the Jay Chou's exposure. So for FY24, what they think will have can bring them back to 38 million profit is that they're going to hold 8 concerts for GHY outside China. These 8 concerts doesn't mean 8 shows. It might mean more than 8 shows, because one concert he can perform for 3-4 days, right? And then they will also invest in his concerts in China. The stake will range between 10 to 40%. And in 24 also, there will be 2 long form dramas they will produce. So this compares with one concert, 2 shows, and 1 drama in FY20. And also, she thinks that this year, first half 23, they had if you look at the revenue line, there's a concert item, 13.8 million revenue derived from concert. There's 2 concerts in Malaysia and Australia for GHY, right? And because these concerts are held this year, concerts are organized like 1 year ahead, and they think that she thinks that these tickets were sold at pre-COVID price, and now the post-COVID, the concert ticket prices have risen. So my estimate is about between 10 to 20% increase. So therefore, that's how she leads her to think that the FY24 could match FY20 volume and profit. Okay, the outlook for them is the China reopening. It allows them to shoot more movies and dramas, more production work, and especially those that they need to be carried out in China. Then there's a border reopening, allows more concerts and large-scale events to be held for the audience to travel cross border to watch. Then there's more also, she also pointing out to more demand for entertainment. So I check out with Mao Yan Entertainment. According to their Mao Yan Entertainment, which is listed in Hong Kong, the China box office has reached an all-time high in the summer season. So alluding that, also agreeing that the demand for entertainment services has risen. Okay, that's all I have for my sharing today. I'll pass it on to Zane for technicals. Thank you.
Thank you, Peggy. I'll move on to the technicals. So for S&P 500, we are currently resisted by a short-term downtrend resistance line shown in the chart, and we are currently under the previous resistance. Now currently acting as resistance still at around 4440 to 4480. So for this week, we could see a little bit of the range trading actually continue on from last week, with the support being at 4325 to about 4360. Next slide. For individual counters, we have Nike. So for this is a technical sell at $102.86. Take profit levels at $92.82. The stop loss can place at $108, and the stop loss close at $98.84 on Friday. So for Nike, there was a breakdown of a consolidation triangle, continuing on its midterm downtrend. You can see the MACD is also displaying a weak momentum with lower highs form. So if that is possible, that the stock price could go on to test the $92 level first, which was a prior range resistance back in October to November of last year as the first level, and the second level of support could be at $82, which was a swing low formed in late September of last year. Yeah, so that's all from me. I'll pass on my time to Paul to talk about Singtel, to give an update on Singtel. Thank you.
Yep, thanks, Zane. Move on. There are 2 reports on Singtel. One is their first quarter. You go back to the earlier slide. First quarter 24 update, and also Investor Day. So as the title suggests, the weakness for Singtel's results has been currency down and margins under. It's mainly Australia, I mean, down under. Next slide. So the results was generally within expectations, but what was also dragging the EBITDA down by 8% has been the 9% decline in Australian dollar, which is mainly Optus. So Optus is the second largest mobile operator in Australia. You can see from the table on the left, there's also a 14% decline in Australian consumer, which is essentially Optus. The bright spot has been a stellar performance for Bharti, the Indian mobile operator. So you can see on the left again, the profit after tax was up about 33%. A bulk of the increase is due to a rise in ARPU. ARPU is basically mobile selling price, so it's the average revenue per unit. Then the other growth driver was digital infrastructure. You can't see from the table because this is a new division they set up. This is a new division set up by Singtel to house all their submarine data centers and satellite business, which I think they will eventually try to spin off, or if they don't spin off as IPO, they will try to sell some stake in it. So this will also be another catalyst for the stock. The negatives, of course, Optus margins down, margins down because they continue to, they still have challenge in controlling operating costs, in my view. And we'll discuss later why the competition is extremely strong. So in Singapore, we have 10 MVNOs. So MVNOs are like Circle Life, but in Australia, there are 40 MVNOs. But we'll discuss later on when we talk about the investor day. So in the outlook, we lowered our target price, and we are up mainly because we lowered our EBITDA forecast. But we upgrade from buy to accumulate due to the recent share weakness. So there are catalysts for Singtel. Part one of it is there are 6 billion of asset monetizations. This means they are looking to do like what Capital Corp kind of did, dispose of assets. Some of it including the building, Singapore Com Center, the data centers, and even IPO of NC as well. Yeah, we'll elaborate more later. Next slide. So after their results, they also had an investor day. So for us, we think directionally is healthy. I think we think the earnings more or less bottom out, and it's going to be directionally there's going to be growth, but of course the pace of it will depend on Optus essentially. Next slide. So in terms of the highlights for us, there was a mobile price recovery, which has happened mainly in India. A bit delayed in Philippines and Thailand, and likely in Indonesia. So we'll discuss later when we talk about the associates. But the one that's facing the most problem is Australia, and then followed by Singapore to a certain extent. There is growth drivers for Singtel, although mobile may be a mature industry, penetrations are even more than 100%. But what will drive it will be, of course, like we mentioned, mobile prices rising, and there are also new growth drivers that they'll be investing in, which is fixed broadband, which is like our home broadband, when we mean fixed broadband. One of the growth drivers is because penetration is lower. In Indonesia, the penetration is only 17%. I think they think they can even double the penetration in the next 2 to 3 years. There's also upside in dividends. So they did say that they had about 2 billion of excess cash yet to be returned. So they need to do like a 60 to 80% payout ratio. So 2 billion is roughly, they computed about 11 cents, and Singtel normally, Singtel pays about 10, 11 cents dividends. So I think that there's a lot of upside to dividends because they have some excess cash. And their plans is to just pay dividends out of operating cash flow. Then special dividends is from disposals and so on. Of course, the other item was, of course, generative AI, which was discussed earlier by Max. But for us, I think, having spoken to them, I think our own view is that we think generative AI will be a very strong demand driver for data centers. So to give you a sense, so in a particular rack in the data center, rack is like the one tall shelf of, whenever you see a data center, one tall shelf of computers. So usually their average power consumption is about 12 kilowatt. But once you put in GPUs, the Nvidia GPUs, you're talking about power surging to 50 to even 80 kilowatts per hour until you need liquid cooling because it takes out a lot of heat. So what this indirectly means is that a lot of data centers is going to have extra demand because most of the data centers are normally measured by megawatt. So the one that Singtel is building is 58 megawatt, means they only cater for this much of power. But if you put in generative AI and everything, although you might have enough space, but you may not have enough power. So data center supply, we think, can be soaked up very quickly. The other thing on generative AI is that they did mention that if you try to buy a GPU now, I think you will only get it, it's probably 2025, because 2024 is all fully booked out because there's not enough supply of GPUs. So in terms of the comments by the CEO and CFO, they will put in more capital in the growth areas that we mentioned, fixed broadband. and they are willing to pare down associate stakes. So that was always something that they never did, but they did pare down a bit in Bati and then return some of this because. So anyway, the reason is that when we measure Singtel, about maybe 30% of the value, roughly 30-40% of the value is from the Singapore and Australia, and the rest, 60% come from the associates, the listed associates like Bati, AIS Group. So they did say that they are willing to pare down. So if they pare down, then the share price can actually move because it will narrow the discount because Singtel is probably trading at 30-40% discount to all these listed. Because Bati, their stake in Bati is even more than the whole listed, their market cap. Around there, quite close to market cap. The other thing they want to do is, of course, raise their return on invested capital from 8% to low double digit. Of course, everybody wants to have these targets or grow taller, but I mean, I'm not sure whether they can achieve it, but I mean, that's their target. So some of the ways that they're going is, of course, the growth areas. The main one is on the associates. The one that's growing very well, it continues to be India, which is Bati. Mainly because prices is rising, and ARPU is rising because their customers are moving from prepaid to postpaid. And of course, when you move to postpaid, you tend to spend more and the price points are higher. They're also moving to 4G. There's like 100 million of feature phones. And that means those feature phones means non-smartphones. So when the customer upgrade to a smartphone, they usually consume more data and the ARPU will jump maybe almost 50 to 60%. There's other family plans, data monetization. What it means family plans that once you get one family member in, they tend to share and secure more family members into a plan. But anyway, one of the reasons that Bati can also, you can see the customers spending more on telcos because the economy in India is also doing very well. So this also helps. So the strong economy is also helping the telco industry upgrade. All the customers are all upgrading because the economy is strong. You don't see it in the other countries like Thailand and Globe. So although in Thailand, Advanced Info or AIS is only a duopoly, that means there's only 2 mobile operators. But because of the economy is weak, you don't see the same thing that you see in India. Because in these countries, prepaid is considered a discretionary item, considered an expensive item. So until the economy recovers, then you get a strongest growth in ARPU or selling price. The other growth driver for them is 3BB, which is they're acquiring a broadband operator. In part, it's also defensive because the other competitors have broadband. So with that, at least the other competitors won't do this, the bundling that we used to do a lot, that like Singtel, bundle mobile with broadband and try to get new customers. There are more details in my report, so I won't go through so detailed, but Globe is another growth. There are 2 operators. The third one is actually supposed to be China Telecom, but that is languishing because it's called Dito, because China Telecom was supposed to be the third mobile operator and have the majority stake. But because I think Philippines government changed the rule, so they said that if China Telecom were to take a majority stake, then they have to open up the Chinese mobile or telco market, which obviously China won't do. So the third operator is obviously languishing because there's not going to be any capital injected by China Telecom. GCash is one of the strong fintech in Philippines. It's the one that does all the payments and even loans and so forth. The other earning probably catalyst for Singtel is if they start to go IPO maybe in the end of this year. Telkomsel is the largest mobile operator in Indonesia. They're moving to broadband. They acquired IndiHome, which is part of Telkom, and this is a new growth driver for them. So basically, in a nutshell, all the associates are performing well, and this can help the Singtel share price. The problem is still Optus. So Optus is competing against 40 MVNOs, and these MVNOs have 25% market share. Because MVNOs in Singapore, like Circle Life and all that, they only survive because Singtel needs to rent out their network. Because MVNOs means they don't have their own network, then they have to lease the network from maybe someone like Singtel. But in Australia, what's happening is Telstra, which is the Singtel equivalent, is leasing these networks. But of course, the question is, why would Telstra want to open up and then let so many competitors come in? Because Telstra has very strong hold on the high-end customers. So they actually wholesale all this to most of these MVNOs so that they can compete against Optus and TPG, the other mobile operator. So actually they have the top end and then they use the low end to go and take on the other competitors. So the problem is that competition won't abate, and that's why we think Optus will still be weak at least for the next few quarters until Telstra kind of stop all these mobile plans. Then the Singtel Singapore, the only comment, or I guess the only interesting thing is that they are still looking forward to some consolidation in the mobile industry in Singapore. They cannot do it. I mean, Singtel cannot acquire anything because of anti-competition rules, but it's going to be more like StarHub and M1 doing the consolidation. NCS, the IT services, they have a target to double their revenue, so this could be another growth driver. The final one is the digital infrastructure. They have 62 megawatt of data center in Singapore. They're doubling it, and I think the new one, 58, is almost filled up already because in Singapore there's a shortage of data centers. Next slide. Okay, I'll go to Q&M. The first half results, as the title suggests, because they did major expansion, they just need to fill up the new clinics. Next slide. So for Q&M, the revenue was in line, but the profit was only 30% of forecast. What is happening is that over the last 2 years, they grew their number of dentists by almost 30% in Singapore. But the problem is that filling these new clinics has been weaker than expected. So what they're doing is they're growing the number of dentists so that these dentists can occupy this new dental chains. They have stopped opening any new clinics since September of last year. And the other thing that is happening is that the bottom 20% of the clinics, which if you do the maths, about 30 clinics, are loss-making. So they have to try to upgrade these dentists to turn them around rather than do any further expansion. The negative is, of course, not unique to any Singapore company. It's just that when your revenue is weak, you're going to get negative operating leverage because your fixed cost is just kept up because of the higher wages, the absence of wage credit. And they're also at the site doing this AI software, where once this software is completed, you can actually go to the dentist, and the software will give you a recommended treatment plan. Just in case you don't trust your dentist. Dentist is an AI which is like approved, and they will tell you which is the best treatment for your teeth, I guess. We cut our earnings, we downgrade to accumulate, and this will be another year of consolidation for them. They are still recruiting new dentists, investing in the new existing chains, and try to upgrade the poorer performing dentists. Next slide. Last one for me is Netlink, waiting for tariff review. So next slide. So there's the update by Netlink. Netlink results always, nothing. It's just going to move sideways, very slow. Of course, this quarter you saw a jump in 6% in revenue, mainly because of the divergent revenue. But divergent revenue doesn't really contribute much in EBITDA. So that's why the EBITDA is up only 3%. The key one is their residential, which is charging people like us. I mean, all of us use Netlink at our home. Those are results within expectations. There's one opportunity they did highlight is the broadband plans now. That means all of us at home, some are upgrading from 1 gig to 10 gig, and this will mean there'll be more equipment installed. I mean, you don't need to put in new fiber because the fiber can accommodate, but in the premises where all the equipment is, you need to upgrade the equipment, need more space, need more power, so they can have an additional growth there. Negatives is the slower than expected connections. We were expecting maybe 25,000-30,000. Now they're trending about 16,000, 18,000. So it's below. And of course, the one issue that Netlink might have is the interest expense. So as you can see, their interest rate is only 2.6%. That's because they hedge almost 70% of the debt up to 2026. So interest will not be an issue for the next 2 to 3 years, but then you face the risk that interest will climb up by maybe another 4-5 million at least if interest rates remain high. But until then, next 2-3 years, I think they can still maintain the dividends. No change to our target price. The key thing to watch for is there's going to be a new fiber rate. So because fiber is a monopoly in Singapore, so obviously they cannot charge whatever they want. Whatever they want to charge, they have to have discussions with the IMDA or the authorities. The review is supposed to be released early this year, but delayed. But they say anytime soon the new fiber rates will be announced. We think the fiber rates will be slightly lower, but it won't really impact them that much because they can always use debt to pay dividends. if need be. And anyway, they're paying a 6% dividend yield. It's sustainable because they're collecting like 1380 every month from 1.5 million subscribers. Like people, I mean, households like us, of course. Next slide. So I'll just quickly run through the Phillip weekly. Not much. In terms of the Singapore, the main thing is mainly RevPAR. So RevPAR is the hotel room rates adjusted for occupancy, because you can't just use room rates, right? But anyway, room rates in Singapore is now hit $290 and occupancy is 90%. So actually RevPAR, not highest in 20 months. RevPAR now is an all-time high. So anyone coming to Singapore now is an all-time high in terms of room rates and occupancy. Occupancy is 90% in the industry. So you can imagine the room rates is just going to climb up even higher. And we think it's sustainable. We'll discuss later because of in the US, not much macro news. The key thing is just Jerome Powell's speech. For you to read about, anyway, he just still reminds everyone that no, inflation is still high. And the key thing was to remind everyone that they are still prepared to raise rates if it's appropriate. Because inflation is still high. But if you want to know more details of how he see inflation, he said there's 3 parts to inflation. There's goods, which we all know is coming down after the pandemic. There's housing, which is rent, a nicer word for rent. He said it will take time, but he sees the market declining. The one area of inflation which is less clear for him is the non-housing services, which is everything except rent, which is the restaurants, which is education, healthcare. That is affected more by labor. So that one is a bit more unclear whether inflation is going to trend down soon. Yeah, but regardless, he just says that if he will raise rates and he expects the economy to weaken because of these higher rates. So he just says that the effect of trying to reach his target means that the economy has to slow. Next. Okay, then in terms of tactical views, this is my last slide. I think we are still we think although the Fed speech was within expectations, it was still hawkish. Hawkish means he's still saying that he's open to raising rates. So what we see, the market narrative by the market is now, the narrative now is that we expect in the near term, back to higher for longer interest rates. So if interest rates remain elevated, what it means that equities will face a bit of competition, because there's attractively yielding fixed FD and money market funds. And then this will be positive for banks if interest rates remain higher for longer, and of course for cash-rich companies, Propnex, Aviation, and so forth. But of course, it will be negative for REITs in the near term. But the hotspot continues to be hospitality, because in Singapore we have a record RevPAR, or record room rates and occupancy, and we think this can be sustained because the China arrivals only just arriving, and then we have multiple events in Singapore. Below are some of the events to watch for, but the key one will be the inflation number on the 31st of August and also the US payrolls. And we have a few webinars this week. Feel free to sign up. Sorry, we didn't have Uni Asia this week. Then we have the rest. Okay, thanks. I think we can move on to questions.
I'll
Thanks,
take
Paul.
sorry. John, go ahead or?
Go ahead.
Okay.
Go ahead. I'll take it later.
Okay. Yeah. I have 2 questions, I think. Let me try to find it. Yeah. First one is semiconductor industry. Based on the optimistic outlook from major semicon players in the US, have we been the bottom of semiconductor industry, and would Singapore-based semicon players like AEM, UMS, Franken profits benefit from the tailwind of better demand or supply going forward and sustainable AI growth? I'll answer for the US side. I'm not sure whether Paul wants to add in for the Singapore side later, but for the US side, based on the presentation that I gave just now, I don't think they are really that optimistic from the US players, because most of them are still expecting a revenue decline. But in terms of whether we are already at the bottom, I think there's a chance that we're already at the bottom, because they are already saying that the price decline have already like bottom and slowing down, and you can see that the year-on-year revenue has also the year-on-year revenue decline has also slowed down compared to the previous few quarters as well. So I think, yeah, you can say that they are expecting a better second half, but it's not like, a huge optimistic outlook or a huge growth expected, a positive growth for the second half as well. I'm not sure whether Paul wants to add the comments on AM, UMS, and Franken. And then, yeah, I think Paul, you want to go ahead first?
Yeah, okay. Also among the three, for me at least, probably most positive on Franken because they have ASML to support. Then for UMS it will be second because they have applied and they have a new customer. AM is a bit tricky because AM will depend on Intel, and I don't think Intel is penetrating on GPU, and also like probably Max might mention also the CPU also might be in trouble if Nvidia starts to go into CPU. So Franken probably the best for me at least in terms of if there's a recovery that will bounce. The swing factor is memory, which nobody knows. So memory will be the one that will give you the beta, the extra surge in semicon. Until then I think semicon will just be trending maybe low to mid single digit kind of growth. But it's a memory that will give you the kicker. Correct me if I'm wrong. I mean, Max, you're probably the expert. I'm just mumbling.
Yeah, I think you're right. Then my next question, the next question is, what could be the explanation to ASM Technology Hong Kong share price performance so vastly different from ASML and V? Yeah, so they are two different companies. So the reason why ASML, and they're two different companies, and they also produce different types of equipments used. So for ASML, the reason why they are able to provide such a strong financial result is because they are the only one that produces a lithography equipment. So what lithography means is it's kind of a machine that is used to print patterns on your chips, and they use this so-called the UV light, the ultraviolet light, and ASML is kind of the only ones that is able to make the most advanced type of these machines. So yeah, whereas ASM Technology from Hong Kong, from what I know, is that they are making the other kind of generic equipments used to manufacture the semiconductor. So yeah, it's not really comparable between the two. So hope that answers your question, and I'll hand it over to the rest of my colleagues. Thanks.
Thanks, Max. There are a few questions for Tesla. The first question here is, how is Tesla's zero emissions versus others? So zero emissions essentially is it's an industry, or it's like a global wide thing. It's not even just your EV industry. But essentially it's not like there's no emissions coming out. It's actually a net zero emissions. So what a lot of countries are doing right now is to promote this or mandate this net zero emissions by a certain timeline. Essentially, it's like right now, if you have, for example, your automotive industry that's producing, I don't know, 10 tons of carbon dioxide a year, for example. And then, every car that you sell, every additional CO2 emissions, for example, if you sell one ICE vehicle, for it to be technically net zero, you have to sell an EV, or at least 2 EVs or 3 EVs or something like that. The concept is more like, I guess, you just got, instead of planting trees to combat, your CO2 emissions, you're planting EVs. It's a little bit complicated because it's not as simple as no emissions. So it's a little bit complicated, but most it's the same across all industries that are trying to go through electrification and stuff like that. Yeah, I hope that kind of answers your question. But it's actually all zero emissions are the same. Net zero emissions are the same concept. There's another question here on Tesla. Hi, John. Why would Tesla reduce the cost of EVs when there's a long delivery wait times? Okay, so the first reason is they want to make it more affordable to consumers, because right now most of your consumers will be buying, at least in the US, they'll be buying cars that are in the $25,000 to $30,000 range. So that's your mass market. Right now they're at 45,000, 50,000. And so they're a little bit more on the premium side. So you're not really, affordability wise, you're not opening up yourself to the biggest volume or the biggest category of volume. So that is one of the reasons why they are trying to reduce the cost so that they can reduce the selling price. Yeah, and the second question is there a benefit to gain market share and suffer profit margin? So I guess with respect to growth companies or early stage growth companies, like a lot of the EVs, the strategy is always, I want to gain as much market share as I can first, and then I expand margins later, because most companies believe that customer loyalty or brand loyalty will be strong, even if they raise prices. A consumer will just upgrade to the next, I guess your newest version of whatever product you're buying. So in that sense, there's a benefit, and especially in such a young market like the EV industry, that's actually what a lot of the people are doing. A lot of the players are doing right now. In relation to Tesla, they're not. I guess they're not really that concerned about getting market share because they're already a big player. What they're more concerned about is being able to reduce selling prices, while maintaining their profit margins. I think that is like number one on what they're focusing on right now. Third question here is there any more profit to be made for EV car manufacturers after the sale of vehicles versus petrol cars, where the after sales profit comes from bundling warranty and services and servicing the vehicle at the authorized distributor? So it's basically the same. It's just that for EVs, a little bit more complicated EVs like Teslas and so on, because they're a little bit more complicated, you can't just send it to any. First of all, Tesla doesn't use any authorized dealers, so they go direct to consumer. All their servicing centers are operated by Tesla itself. Secondly, you won't be able to. It'd be very difficult to send your Tesla to, let's say, just a random workshop. If you need work done on your Tesla, even any body work is very difficult because the way they manufacture a lot of their parts is very customized, and like I mentioned earlier, they're trying to reduce the number of parts in their vehicle. So essentially, they're trying to make like a one whole piece body, more or less. So if you let's say get into an accident, it's very difficult to go to just some random shop and tell them, I want to fix this, because they might not have the expertise to do so. Specifically for Tesla, when it comes to aftermarket servicing, they excel because they collect a lot of data from the cars when they're driving. So they're able to predict, when how much servicing is needed, when it's needed. They're also able to get the parts ready, so that it reduces a lot of your service wait time. And then for other after sales products like vehicle insurance, same thing. They collect a lot of data, so they're able to price their insurance, or at least mediate the risk to premiums, the premiums to their insurance, at least comparable or lower than traditional insurance providers. So it gives them a little bit more advantage. And for the consumer side, you're just dealing with one company like Tesla. If you get into any accident or anything like that, you just go straight to them. They handle insurance. They handle your repairs and maintenance and everything. So it's more on a convenience thing, but at the same time, if they can do it better like Tesla, because they collect a lot more data, they can reduce a lot of your costs, reduce a lot of the waiting time for the consumer. There isn't really much difference when it comes to after sales revenue from EVs and ICE vehicles. It's just that because EVs are a little bit more complex in their design, they are, I guess, a little bit more well equipped to deal with a lot of these things. I hope that helps. The fourth and last question here is, what is the product positioning for Tesla? Is it positioned as a premium car, so like a Camry, Mercedes, BMW, or is it a mass market car? So they have actually their premium models are actually the Model X and the Model S. So those are the premium ones. They're a little bit more expensive, but sales for your S and X are actually very low right now. They're not really focusing on it as compared to the Model 3 and Model Y. Model 3 and Model Y, they are trying to make it more mass market in their pricing, but it's still, on the higher side, so it's catered towards the more mass affluent. So not really on the same page as, like say your Corolla or your Altis, but they are trying to get it down there, like I mentioned earlier, so that they can sell more cars. That's essentially the positioning for Tesla. At the same time, they're also coming out with their new Cybertruck to penetrate the pickup truck market in the US, which is huge. And they also are starting on their Tesla semis, which is more on your commercial side. Your big trucks that allow you to transport goods from point A to point B. Yeah, I hope that helps. The last question here is, please enlighten what is Rule of 40. Yeah, so the Rule of 40, essentially, it's a gauge to measure growth and profitability. So the growth aspect comes from your 3-year compound annual growth rate, and then profitability comes from your margins. So essentially, why it's 40%, it used to be used for your SaaS companies, and this was to offset the fact that a lot of SaaS companies are growing fast but losing a lot of money as well. So it's just kind of to find a balance between growth and profitability. Yeah, hope that also helps to answer your questions. I think I don't have any more for. Oh, sorry, there's one more. Did Grab discuss about their game plan for the recently acquired Malaysian grocery chain? So I think the grocery chain you're referring to is GHY Grocers. Actually, they were acquired in the first quarter of last year, and what they've done is that they've integrated GHY Grocer into their deliveries business, so it makes them a little bit, specifically in Malaysia. So because GHY Grocer, there are a lot of GHY Grocer chains, so it just makes their logistics a little bit easier. And they've seen quite a lot of benefits from it in terms of increased deliveries and increased GMV just by acquiring this grocery chain. Yeah, so that's all the questions I have for right now. I'll hand it back to the rest of my colleagues. Thank you.
Yeah. I might go first.
Okay. I'll take the China Aviation Oil question. Where is it? For China Aviation Oil, the price of 90 cents is a good price to go in based on your presentation and outlook. Also, we don't cover the stock, so cannot comment on the entry price. But based on the management's guidance, second half is definitely should be stronger than the first half. So 1/3 of their revenue comes from oil trading. So once the trading window opens, like I mentioned previously, the regional price difference is opening up. Yeah, so the profit for this part will be boosted, and also like their profit margin will increase. And also like we expect the international flight capacity to be further restarted. But again, it's like it's a very uncertain thing because the policy has yet to come out. Is yet to come out. So yeah, probably can wait for better clarity. Yeah, and then getting, like for example, if there's like a lot of stimulated policy to restart the international flight. Yeah, hope it answers your question. I'll hand over to Darren to answer the rest. Thank you.
Yeah, thanks. Yeah, so for some of the questions, what is your view fundamentally and technically on CapitaLand Ascender Street and CapitaLand Escort Trust? Yeah, so technicals I will leave it to Zain. Yeah, but for both CLAR and CLAS, they issued a equity fundraising. For CLAR, they did a private placement, so that wasn't well received by the markets. As we saw the share price, yeah, it really crashed even below the placement price. And yeah, so fundamentally, CLAR, operationally, they're still doing well. NPI growth, low single-digit %, and we expect rental reversions to remain strong. For CapitaLand Ascender Street, like maybe low double-digit or high single digits rental reversions. But but of course they're affected by interest rates. And for Capital Escort Trust, actually they are preferential offering. The shares are supposed to begin listing on 1st September, but we all know 1st September is now a public holiday, so it's pushed forward one day. Yeah, so right now the share price is $1 and it's really under the fundraising. I mean the preferential offering price of $1 and 0.25 cents. So what we worry is that because it's fully underwritten, we are worried that the book runners and the managers who are in charge of the underwriting, they might kind of, we are just worried they might sell the share, so there might be a bit of weakness in the share price for Capital and Escort Trust as well after 1st September. So that's next week. Yeah, but fundamentally, yeah, we still like Escort. We have a buy call, a $1.20 target price because of the strong recovery in RevPAR, like Paul mentioned for Singapore. And yeah, there's another follow-up question on that as well. Yeah, is weak given RevPAR hovering at all-time high of 261 Singapore dollars. Why do you think class is still weak post-rights? Yeah, because of the thing that I mentioned before, that there might be some overhang in the share price, like the fully unwritten shares might be sold off in the market. So, but the thing about that, the RevPAR at 261 is because Escort has about 15% of their assets in Singapore only. So geographically, is not a very big percentage, but across the board, all of the RevPAR is still growing. Yeah. So, but the weakness near term, in my opinion, is just the fundraising. Yeah, the markets didn't really take the fundraising too well. So that's my opinion. Yeah, then the next one is, can you share the status of Prime US REIT for its gearing and DPU? Yeah, Prime's gearing is about 43%. So based on year-end FY22 valuations, the valuations need to devalue rather, or decrease by 5% for it to hit its 45% gearing, or 15% for it to breach its 50% gearing levels. So there's still a bit of headway, room there. But we understand that Prime might be looking to, I mean, it's a possibility that they try to raise funds, like do an active fundraising to lower its gearing. But all this, they're still considering ways to bring down the gearing. But for now, we like Prime because it's really trading it at very cheap valuations, like under 0.2 times book, and with a DPU of almost 30%, forward DPU of 30%, even after they changed their fee structure from management fee structure to all cash. Yeah, and taking into account the higher vacancy as well, so you're still getting about 30% at these prices. So we think it's a value play there. Yeah. Yeah. The next one is, how does Parkway Life REIT compare with other REITs like Suntec and Mapletree Pan Asia in terms of growth and DPU? Yeah. So for this, Suntec and Mapletree Pan Asia, they are more similar to each other, because they are both commercial, office and retail. While Parkway Life is not a commercial and retail, it's a healthcare REIT. Yeah. So you can't really compare like for like, but based on DPU, Parkway Life's REIT DPU is about 3.8%, which is the same as around the 3-month SORA now. So in my opinion, I think you'll be better off investing in the 3-month SORA actually. I mean, I'm investing in the bonds. Yeah. So Suntec and Mapletree Pan Asia, they are getting at about 5.8% yield. Yeah. Yeah, we do not cover these stocks. And yeah, based on KPDC REIT financial standing, how likely to issue a cash call after the acquisition of the China data center? Yeah, so they actually, KPDC, they have a final payment of about 150 million which is due around this quarter. So we think it's very likely that they'll issue a cash call. And we are still waiting for the news. But they did mention that if they are looking to kind of package this cash call or equity fundraising together with any acquisitions that they might have. So all this news is we are waiting on the news. Yeah, but it's very likely that they will issue a cash call. So yeah, as we seen the previous CapitaLand, Escort and Ascenders, yeah, after issuing the EFR, the markets didn't take it too well. So we do see a bit of weakness in DC for now. Yeah, I think that's all for me. Yeah, one more is Prime is still good, but yeah, we think Prime is a value play now, even though there are headwinds and the US office market seems to be bottoming out soon, maybe end of the year or early next year. Yeah, there might be some valuations decline, but we think Prime will be able to handle it. Yep. So that's all for me. I'll hand over to the rest of my colleagues. Thanks.
Okay, thank you, Darren. I'll take over. Okay, there are 3 questions I see meant for me. Okay, the first one is what price point would SETS be a buy? Can we assume there is growth ahead and further acquisitions? Because I think SETS price would be supported at the recent rights issues price of 220. Of course, we'll probably we'll be very sad if it reached there anyway. But I think in the next 12 months, we don't see much growth in terms of I mean there is growth in the revenue, but the quantum of growth was slow. SIS has already reached about 97% of its capacity already, and SETS derive about 80% of its aviation business from the Changi airport. So in that part, the growth will be slower in terms of ground handling and aviation food. Maybe I talk again about what my view on SETS as a whole. There's a few headwinds coming up, and is that a few things that we like to see for SETS in order to turn it into buy is if we can see double catering reduce. But the recent addition of flights by the airlines, most of them are in the regional routes, the short haul routes, because Asian markets are one of the last to open up. But this short haul routes, there's substantially more double catering. Double catering means that the airlines will pick up the goods from the country, pick up the inbound and outbound food from the country where it's charges the lowest. So SETS, of course, with our strong Sing dollar, is not competitive in terms of pricing here. That's one thing. Second thing is most of the pickup in the load factors are on the budget airlines. Budget airlines, you don't get to eat food unless you book the prime economic plus seats. So most of the time you get to see your neighbors eating still, and you go hungry. Okay. Then the other thing is the food distribution business has been very weak. Under country foods, they supply to they supply the almost ready to eat meal to the supermarkets, and they also supply the food to our army boys. But there has been less exercises lately, and somehow for them they lower appetite, so they're not eating as much. So that portion of the volume has also been very slow to grow. So the things to watch for them is really China and Japan. Where China, they have three kitchens, and Japan has been traditionally a very big market for them, accounting for 10% of revenue. Last year it was only 4%, so they were really banking on Japan to come back up. But I'm not sure how the Fukushima issue will affect the tourism into Japan, and yeah, so that's another not so great news for them. So we think a proper entry price for them, giving all these issues ahead, will be nearer to 230 per share. Because we really hope it doesn't reach there. Yeah. And will there be any further acquisitions? We think unlikely, except for maybe small investments in Malaysia, where they're also trying to build to capture a bigger share of the Malaysia the demand out of the Malaysia airports. So other than that, the net debt is already 2.2 billion as at June 24, and then gearing is about 0.9 times. So therefore, any acquisition will be slower and smaller in size. So we think unlikely there will be significant growth and acquisitions going forward. They will be focusing on integration, cutting costs, but at the same time they also incur integration redundancy costs this year. So FY24 profitability is quite a question mark. But if the most of the gains or improvements will come in FY25. The year end is March this year. It's March every year. I hope I've answered that question. Okay, the next one is regarding, next two are regarding Yanlord. So maybe I can merge them together. You say, thanks Peggy for your presentation on Yanlord. In your view, what are the opportunities from the spillover effect of country gardens in China that are worthwhile exploring? And then the second question is Yanlord a good buy at 70 cents based on your presentation and outlook? Any further risk should be taken into account? Okay. First, I was qualified. I'm a part-time China property analyst. Right? So it's all I talked about just now was really because of my because of the interest in the sector. The spillover effect were really from country gardens results have not been announced. They issue a profit warning. But really, if there's a default of a large private developers like them, we think it could trigger the strongest policy response. So that might bring about a better, a healthier market for the entire China property sector. I have to qualify also that China Country Gardens has 98% of their land bank in the tier 3 and lower tier cities. And these cities are those are the most speculative, where it's not supported by population or GDP. So and the restrictive measures in the past has always been very little compared to tier 1 and tier 2. So any policy that could come in to roll out to help would probably benefit the tier 1 and tier 2 cities more. And in that sense, Yanlord stands to benefit because about 75% of their land bank are in tier 1 and tier 2 cities. What we think, what we are expecting is more policy support measures from the government, be including easing of the property restrictions like price restriction, limitation on sales, like how many properties you can own. And all these restrictions have always been a lot in tier 1, tier 2. So if they lift this, it will benefit those with tier 1, tier 2 exposure. Then they also could be talking about asking the policy banks to set up a special fund to protect the buyers of these properties. So therefore, it's already happening. The property developers already have to exclude their funds, just like Singapore, how we do it in Singapore. So they probably have a stronger controls over this area, and that will give the buyers more confidence to look at purchase again. The worst thing that we would think will happen is if these policies roll out takes longer than usual to roll out, then the confidence may wane off, and then that it could cause the prices to fall even in the secondary market. So also the market is also looking out for additional RRR cut and maybe another MLF rate cut in the second half of this year. So all these policies, if they move up, it will benefit all the property developers, not just Yanlord alone. Yeah, and the lower mortgage rates will actually, if you are existing property owners, you can choose to refinance at a lower rate. So maybe you have think twice about selling out your property. So that is also a good thing for them, for property developers to at least ease off the pressure on the secondary market. So I hope I've answered the question, but I also like to qualify that from now till all these rolls out happen, and depending on when they roll out, the confidence will wane as the day goes by. We still got likely to see the deepest property downturn in the China market. So there's still some more downside for the sales as well as new starts for going forward. So whether 70 cents is a good buy right now, I really can't tell. Sorry, I don't like to recommend when I don't have my data properly out. But suffice to say, this is a period that all the developers will go through. Maybe when the policies are rolled out, it might be give you a clearer picture of how well who are the ones that are still standing and how tall they will stand after this whole entire things is over. Yeah, thanks. I hope I answered that question. Thank you. I pass on to the rest.
Yeah, I think let's go technicals, I think, in view of time. Yeah.
Okay, thanks, Peggy. I'll share my screen right now. Okay, so the first one, I'll go through in chronological order. The first one is Manulife US REIT. Okay, so for Manulife, currently it's still trending downwards. For now, the immediate resistance likely to be around the 7.6 cents level over here. And as for immediate support wise, it's still making new lows every day. So I can't really give you a good support based on that. The next one is Capital and Escort Trust. So for Escort, is still holding up around the $1 mark over here. So the price is still sideways, and this was like a previous support over here as well. So yeah, I think price is still just sideways hovering at these levels. Resistance is around 103 and above. Then next one is XPeng. So for XPeng, after it retested the prior resistance, which was around $60, it found some support, and then price traded sideways before a gap up today. So the near-term resistance likely to be around could be at $77 to $78, which was a prior support and resistance, and then could be a retest of this trend line over here as well for XPeng. Okay, then moving on to the three local banks. First one is DBS. So DBS after it retested this key level around the $32.40, which was a prior resistance over here, which broke out, and then there was a retest. There was a bounce. Currently price is around 33.30. So there might be some resistance coming in at this level because this was a range level that was broken down previously. So now it's a retest taking place. So yeah, there could be some sideways movement over here if there's some resistance coming in. Then next up is UOB. So UOB, similar to DBS, there was a retest of this key level around 27.70, 27.80, and recently we have a bounce place over here. So near-term resistance could be a retest of the level around 2860 to about 2880, this zone over here. Then as for OCBC also bounced after retesting around 1220, this key level. Near-term resistance could be at around 1250 to about 1260, this zone over here. Okay, then for AVGO, Broadcom. Okay, Broadcom, currently I think I would say it's a bit of a range trading. After it found support around 820 last week and bounced, also cleared this 850 level over here. But we had a retest of this prior range support that was being broken out at around 880s. We saw some selling took place over here. Price over here is still maintaining around 850, so we can expect a bit of a range between this 850 to about 880 level over here for now. Okay, then next one is Hong Leong Finance. So for Hong Leong, nothing much, is still very much in the range over here. So the key support is still around 245, or the resistance is likely to come in around 250 onwards to about 253 over here. Then for AEM, okay, AEM price currently rebounded after going near the support level around $3.08 over here. Currently, we are retesting a prior support level, could act as some sort of resistance around 353 over here. And further upside resistance could be around 368, which is this another support level previously. And this was like could be a retest of this blue color uptrend channel that we broke down off over here. As for Parkway Live REIT, okay, Parkway Live REIT, I think nothing much, still trading in the range over here. So key resistance over here is still around 385, and the next key resistance could be from about 395 to about 398 over here. Okay, then TA on some of the US counters, Nvidia. Okay, Nvidia, there's still resistance around above 480s over here. There was a retest, and after results, we had a gap up and sell down over here. But price currently is maintaining at this level at around 455. So this is the one level of support over here. Also maintaining above this trend line break over here. And so is this supported? We could see a little bit of a range between 450 to about 480 over here. The next support level below 455 will be around 435 over here. If it doesn't hold up, yeah. And as for TSM, TSM rebounded from this blue color trendline support over here. Then currently there's some, if we tested this black color uptrend channel, which was broken down at around $95. And over here, this was a very strong support previously around $97. So 95 to 97, this zone, expect some resistance coming in at these levels. Yeah. Then support will likely be at the recent lows, which is close to $90 to about 91 over here. So you can expect some sort of range movement over here for now. Okay, then for Berkshire Hathaway, Berkshire is still trending up pretty well. Price still holding up at a recent support around 350 over here, and then as long as price can stay at around 354 above this level over here, there's a chance for a retest of the recent highs, which is around 360 to about 364 over here. Okay, then I'll talk about Yangzijiang. Okay, Yangzijiang, currently I think we could be testing this main uptrend channel resistance today, which is around 174, 175 today. So it could be some resistance at this level, at these levels, yeah, for Yanzhiang shipbuilding. Okay, then for capital, I'll go through two more in view of time. So for Capital Corp currently, I think we are in a bit of a range movement. So the support is close to about 660 to about 660 to about 670 over here. Then resistance, the key resistance is about $7 to about 708 over here now, which was this range that we've broken out of. So currently price is just sideways over here, and then we have a bounce coming. Yeah, so there's some still some possible upside over here to try and retest this prior support that we've broken down off. Yeah. So, but for now, overall, the midterm view is that it's in a bit of a range over here. Then this one is Sembcorp Industries. Okay, so for Sembcorp, the chart pattern wise, looking a bit weak for now because previously there was a breakout over here, and there was a retest that took place at around 560 over here, which was also a prior resistance. Our price failed to hold last week, and then we actually sold down all the way until it tested the next level of support, which is around 520s, before we have about retest today. So over here, I expect some resistance around 560s over here on should we retest this level again. Then for support now is around 520s over here. So for now, could move into a bit of a range, more of a range pattern in midterm. Yeah, then the very strong break uptrend as well as the breakout that took place over here is invalidated over here. Yeah, so this for SEM Industries. So that's all from me today for TA. Thanks.
Okay, thanks. What's the different levels of Phillip recommendations? I know there's accumulate, downgrade, neutral. Okay. So every recommendation has a certain amount of price appreciation. So buy means a gain of more than 20%. The meaning of downgrade, upgrade means we change our views. So of course, downgrade means we're downgrading from a buy to accumulate, from a positive view to a less positive view. And upgrade is of course the vice versa. In terms of there was let me try. There's quite a lot of questions I don't think I can answer all, but who is Netlink's competitors? Who can replace them if IMDA decide to choose someone else? Yeah. Netlink. So Netlink is the one that has all the fiber ducts. The equipment is easy to replace, but it's the ducts, all the underground ducts. So you cannot replace unless you got to go and dig a hole everywhere and replace it. Not to mention the central office. So that's why IMDA controls of the in terms of the amount that they can charge and the returns that they can charge every 5 years. What is the competitive advantage of Singtel has other competitors? I think of course like all mobile operators is the license one of the competitive advantage. The thing is that there's only 2 operators in most of the countries that they operate, or 2 or 3. There's a huge amount of consolidation. So it's just an operator, but the problem with mobile operators they've been like, lack of better word, kind of a dumb pipe. A lot of them use them. A lot of the value went to all the apps and all the large big tech companies. So the thing now is they're trying to change so far. But that's the competitor. I mean, I don't think I can go through through everything, but anyway, thanks for your questions. We'll try to answer some of this in P3. In view of time, and with that, I'd like to thank everyone. Sorry, it's a bit of a drag, and sorry we can't answer everyone's questions. But do look up. We normally post some of the questions in our P3 community app, and hope to see you again next week. And thanks everyone.